Let me tell you something that keeps me up at night, something that has cost investors trillions of dollars over the decades, something that most people never see coming until it is far too late. I've been reading financial statements for over 70 years now. I've analyzed thousands of companies. I've made billions of dollars finding undervalued businesses. But I've also watched countless investors lose everything because they trusted numbers that were designed to deceive them. And here is what terrifies me. The companies that use these tricks aren't always the obvious frauds. They're often well-known names, blue-chip stocks, companies that your financial advisor tells you are rock solid. Companies that appear in every retirement portfolio in America. The problem is that the rules of accounting, generally accepted accounting principles, give companies enormous flexibility in how they report their numbers, and some management teams exploit every inch of that flexibility to make their businesses look better than they actually are. They're not necessarily breaking the law. They're bending it. They're playing games with your money while technically staying within the lines. Today, I am going to reveal the 3 accounting tricks that companies use most often to fool investors. These are the techniques that have been refined over decades. The ones that have survived countless accounting scandals because they're so difficult to detect. The ones that even sophisticated institutional investors miss until the damage is done. But more importantly, I am going to show you exactly how to spot them. Because once you know what to look for, once you understand how these games are played, you'll never look at a financial statement the same way again. You'll have an advantage that most investors will never have. The ability to see through the illusion and find the truth. Let me take you back to 1964. I was running a small investment partnership in Omaha, and I came across a company called Salad Oil Industries. Actually, the company I was looking at was American Express, which had made loans secured by what they believed were massive quantities of vegetable oil stored in tanks in Bayonne, New Jersey. The financials looked solid. American Express had documentation showing they held liens on millions of pounds of soybean and cottonseed oil the auditors had signed off. The numbers checked out. Everything appeared legitimate on paper. But something bothered me. I couldn't quite put my finger on it, but the situation felt too good to be true. So I did something that most investors never do. I got on a plane, flew to New Jersey, and started talking to people who actually worked at the docks. I talked to the guys who loaded the ships. I talked to the inspectors. I asked questions that nobody from Wall Street ever thought to ask. What I discovered was that a man named Tony DeAngelis had been filling those tanks with water and putting a thin layer of oil on top. When inspectors came, they'd dip their measuring devices and hit oil. They'd smell oil. They'd see oil. But underneath was worthless water. Hundreds of millions of dollars in loans were secured by nothing more than an elaborate illusion. American Express eventually lost over $150 million, which was an astronomical sum back then. Their stock crashed. Investors panicked. But here is the thing, and this is what shaped my entire approach to investing. The fraud was possible because people trusted the numbers without questioning the underlying reality. The numbers were technically correct based on the documentation. The auditors had done their job according to the procedures of the time, but the numbers were completely disconnected from the truth. And that disconnect, that gap between reported figures and economic reality, that is where investors get destroyed. This experience taught me a fundamental lesson. Financial statements are not objective truth. They are management's representation of truth, filtered through accounting rules that allow enormous discretion, and some management teams use that discretion honestly, while others use it to deceive. The 3 tricks I am about to share with you are the most common ways that gap between reported numbers and reality gets exploited. These aren't theoretical concerns. They're not rare exceptions. They're happening right now in companies you probably own. Now, before I dive into the specifics, let me explain the framework I use for detecting accounting manipulation. Because understanding this framework will help you apply these lessons to any company you are analyzing. Every business has 2 different stories being told simultaneously. There is the accounting story, which is what shows up in the financial statements, and there is the economic story, which is what is actually happening in the business. In an ideal world, these two stories would be identical. The accounting would perfectly reflect the economic reality. But accounting rules require estimates. They require judgments. They require assumptions. And every one of those decisions creates an opportunity for management to push the numbers in the direction they want them to go. Here is my framework. When I am analyzing a company, I look for divergences between the accounting story and the economic story. I ask three questions. First, are cash flows consistent with reported earnings? Second, are the accounting policies aggressive compared to competitors? And third, are there unusual patterns in how numbers change over time? If a company reports strong earnings but weak cash flow, that is a red flag. If a company uses more aggressive accounting than everyone else in its industry, that is a red flag. If numbers swing in ways that seem designed to meet targets rather than reflect business reality, that is a red flag. Now let me walk you through the three specific tricks and show you exactly how they work. The first accounting trick that companies use to fool investors is revenue recognition manipulation. And I want you to understand why this is so powerful and so dangerous. Revenue is the lifeblood of any business analysis. When investors value a company, they often start with revenue. They look at revenue growth rates. They apply multiples to revenue. They use revenue as the foundation for all of their projections. So if a company can inflate its revenue even temporarily, it can dramatically affect its stock price. Here is how the manipulation works. Under accounting rules, companies have significant discretion in deciding when to recognize revenue. The general principle is that revenue should be recognized when it is earned and realized when goods are delivered or services are performed. But in practice, there are countless gray areas. Consider a software company. When should they recognize revenue from a 3-year contract? All up front, spread over 3 years. Only when customers pay. Accounting rules provide guidance. But management has enormous flexibility in how they interpret that guidance. The aggressive approach is to pull revenue forward, to recognize it as early as possible. This makes the current period look better at the expense of future periods. It is like borrowing from tomorrow to pay for today. I saw this most dramatically with a company called Sunbeam in the late 1990s. The CEO was a man named Al Dunlap, who was known as Chainsaw Al because of his reputation for cutting costs and firing employees. He was brought in to turn around the struggling appliance maker. The stock price soared as Dunlap reported miraculous improvements in revenue and earnings. Wall Street loved him. Business magazines put him on their covers. Everyone believed he was a genius. But here is what was actually happening. Sunbeam was engaging in what is called channel stuffing. They were shipping products to retailers at deep discounts with agreements that the products could be returned later. They were recognizing revenue from bill and hold transactions where customers agreed to buy products but asked Sunbeam to store them. The products never left Sunbeam's warehouses, but the revenue was recorded as if sales had occurred. They were also booking revenue from products sold to third parties who would supposedly sell them to real customers later. These were often shell companies or related parties. The goods would end up in warehouses unsold, but Sunbeam's revenue looked fantastic. When the truth came out, Sunbeam's stock collapsed. Dunlap was fired. The company eventually went bankrupt. Investors who trusted the reported numbers lost everything. Now, how do you spot this kind of manipulation? There are several warning signs you should watch for. The first warning sign is rising accounts receivable relative to revenue. When a company recognizes revenue aggressively, it often has to book receivables that may never be collected. If receivables are growing faster than revenue, ask yourself why. Are customers really buying more on credit? Or is the company booking sales that haven't really happened? I calculate a ratio I call days sales outstanding, which measures how long it takes to collect receivables on average. If this number is trending upward over time, especially compared to competitors, that is a serious warning sign. The second warning sign is unusual patterns in revenue at the end of quarters or years. Companies that are stuffing channels or using other aggressive techniques often show a surge in revenue in the final weeks of reporting periods. If a company consistently reports 30 or 40% of its quarterly revenue in the last month, you should be suspicious. The third warning sign is changes in revenue recognition policies. Companies are required to disclose their accounting policies. Read the footnotes carefully. If a company changes how it recognizes revenue, ask yourself why. Sometimes changes are legitimate responses to new rules or business circumstances, but often they're an attempt to juice the numbers. The fourth warning sign is a gap between reported revenue and cash actually collected from customers. Look at the cash flow statement. The section on operating cash flows shows adjustments for changes in working capital, including receivables. If reported revenue is consistently much higher than cash collected, the company may be recognizing revenue it will never actually receive. Let me give you a more recent example. In the mid-2000s, a company called Delphi, which was a major auto parts supplier, was reporting strong revenue growth. The numbers looked good on paper, but if you look carefully at the footnotes, you could see that receivables were growing much faster than revenue. Cash flow was weak. The company was using aggressive techniques to pull revenue forward. Eventually, Delphi had to restate years of financial results. They admitted to billions of dollars of accounting problems. The company filed for bankruptcy, and investors who had trusted the headline numbers without digging into the details lost billions. The lesson here is simple. Never trust revenue numbers at face value. Always compare them to cash flows. Always look at receivables trends. Always read the footnotes on revenue recognition policies. The companies that are playing games with revenue almost always leave traces if you know where to look. I want to share one more example that illustrates just how sophisticated revenue manipulation can become. In the late 1990s, a telecommunications company called Global Crossing was reporting incredible revenue growth. Wall Street analysts were falling over themselves to recommend the stock. The company was valued at tens of billions of dollars. But here is what was actually happening. Global Crossing was engaging in swap transactions with other telecom companies. Company A would sell capacity to Company B, and Company B would sell similar capacity back to Company A. No real value was being created. It was just two companies passing money back and forth. But each company recorded the incoming payment as revenue. The swaps were structured so that both sides could report revenue growth, even though nothing productive had actually occurred. The cash went around in circles while the reported revenue soared. When the truth emerged, Global Crossing stock collapsed from over $60 per hair to pennies. The company filed for bankruptcy. Investors lost billions. And the executives who had orchestrated these swap transactions walked away with hundreds of millions in compensation they had collected during the fraud. The telecommunications industry was particularly prone to this kind of manipulation because the products were intangible and the contracts were complex. But similar techniques appear in every industry. Technology companies manipulate the timing of license revenue. Pharmaceutical companies manipulate the recognition of milestone payments. Retailers manipulate same-store sales calculations. The specific techniques vary, but the underlying motivation is always the same: to make the numbers look better than reality. One more point about revenue manipulation that I want to emphasize. This trick becomes especially dangerous when companies are under pressure to meet growth expectations. Wall Street loves growth. Companies that report consistent revenue growth get premium valuations. Companies that miss growth targets get punished severely. This creates enormous pressure on management to hit their numbers. And when legitimate growth falters, the temptation to manufacture fake growth through accounting tricks becomes almost irresistible. I've seen company after company fall into this trap. They start with small manipulations, just pulling a little revenue forward to make a quarter. Then the next quarter they have to do it again, but bigger, because the revenue they pulled forward isn't there anymore. The manipulations compound until eventually the whole thing collapses. This is why I am always suspicious of companies that consistently meet or slightly beat Wall Street estimates quarter after quarter. Real businesses don't work that way. Real businesses have good quarters and bad quarters. Real businesses miss estimates sometimes. If a company's results are too consistent, too predictable, too perfect, that is not evidence of great management. That is evidence of managed earnings. The second accounting trick is more subtle and in many ways more dangerous. It is called earnings smoothing, and it involves the use of what I call cookie jar reserves. Here is the basic concept. Accounting rules require companies to estimate future expenses and set aside reserves to cover them. For example, a company might need to estimate how many customers will return products, how many loans will default, how much warranty work will be needed, or how much pension costs will be. These estimates are inherently uncertain. Nobody knows exactly how many products will be returned or how many loans will go bad. So companies have to make assumptions. And those assumptions create an opportunity for manipulation. The trick works like this. In good years, when a company is performing well, management can set aside excessive reserves. They can overestimate future warranty claims. They can assume more customers will default than is realistic. They can be overly pessimistic about all kinds of future costs. This creates what I call a cookie jar of excess reserves. Then, in bad years, when the business is struggling, management can dip into that cookie jar. They can release the excess reserves back into earnings. They can decide that warranty claims are running lower than expected, or that loan defaults aren't as bad as feared. This boost to earnings can make a weak year look respectable, or can turn a small profit into a bigger one. The result is artificially smooth earnings. Good years look a little worse. Bad years look a little better. The volatility is hidden, and investors get a completely misleading picture of the company's true performance. This matters enormously because investors pay premium prices for companies with steady, predictable earnings. A company that earns $1 per share every year like clockwork gets a higher valuation than a company that earns $2 one year and nothing the next, even if the total earnings are the same. So by smoothing earnings, management can increase the stock price without actually improving the business. I saw this most dramatically with a company called WorldCom in the early 2000s. WorldCom was using a variety of techniques to smooth earnings, including manipulating reserve accounts. But their most egregious trick was simply capitalizing ordinary operating expenses, treating routine costs like line maintenance as if they were long-term investments. The effect was to understate expenses in the current period and overstate assets on the balance sheet. Earnings looked great. The stock price soared, then everything collapsed. WorldCom filed for what was at the time the largest bankruptcy in American history. Investors lost over $100 billion. But here is what is important to understand. WorldCom's fraud was eventually discovered because it was so extreme. More subtle forms of earnings smoothing happen constantly and are rarely detected or punished. Companies routinely manage their reserve accounts to hit earnings targets, and most of the time, they stay just within the bounds of what is technically legal. How do you spot earnings smoothing? There are several techniques I use. First, I look at the volatility of earnings compared to the volatility of cash flows. If cash flows are bouncing around but earnings are perfectly steady, something is probably being managed. Real businesses have variable performance. If earnings are too consistent, that is actually suspicious. Second, I compare the company's reserve policies to its competitors. If one company in an industry has reserves that are consistently higher or lower than peers, ask yourself why. If a company's loan loss reserves are half of what everyone else uses, they might be understating losses to boost earnings. Third, I read the footnotes on changes in estimates. Accounting rules require companies to disclose when they change significant estimates and what effect those changes have on earnings. If a company is constantly adjusting estimates in ways that happen to improve results, that is a warning sign. Fourth, I look for patterns around earnings targets. If a company consistently beats analyst estimates by exactly 1 or 2 cents per S-hair quarter after quarter, that is mathematically improbable, unless someone is managing the numbers. Real business performance doesn't hit targets with that kind of precision. Let me tell you about a situation I observed in the banking industry during the 2000s. Several large banks had built up substantial reserves for loan losses during the profitable years of the mid-2000s. Then, as the financial crisis began to unfold, they started releasing those reserves to offset deteriorating performance. The releases made their earnings look better than they should have been. They delayed the recognition of problems. They gave investors false comfort. And when the truth finally became clear in 2008 and 2009, the losses were far worse than anyone expected. The banks weren't necessarily violating accounting rules. They were using the discretion those rules provided to present a misleading picture. And investors who trusted the reported earnings without understanding the reserve dynamics paid a terrible price. The lesson here is that earnings are not facts. They're estimates based on assumptions. And those assumptions can be manipulated. Cash flow is much harder to manipulate, which is why I always compare reported earnings to actual cash generation. A company that consistently reports strong earnings but generates weak cash flow is almost certainly playing games with their accounting. The third accounting trick is one that has destroyed more investor wealth than perhaps any other. It is the use of off-balance sheet liabilities to hide debt and risk. The basic concept is straightforward. Companies have strong incentives to keep debt off their balance sheets. Higher visible debt increases perceived risk, raises borrowing costs, and can trigger loan covenants. It makes the company look less healthy than management wants it to appear. So companies use various structures to move debt and obligations off the balance sheet, making them invisible to casual investors. The liabilities are still real. The company still owes the money, but you won't find it in the obvious places on the financial statements. The most common technique involves what are called special purpose entities or variable interest entities. These are separate legal structures that the company controls, but under certain accounting rules, doesn't have to consolidate onto its balance sheet. Let me explain how this works with a simple example. Imagine a company that needs to finance a fleet of vehicles instead of borrowing money directly, which would show up as debt on the balance sheet. The company sets up a separate entity. That entity borrows the money and buys the vehicles. The company then leases the vehicles from the entity. On the company's balance sheet, you see a lease obligation, which might be classified as an operating lease and not fully reflected as debt. The actual borrowing is in the separate entity, which isn't consolidated. The company gets to use the vehicles without showing the full debt load. This technique was taken to an extreme by Enron in the late 1990s and early 2000s. Enron created thousands of special purpose entities. They used them to hide debt. They used them to hide losses. They used them to create the illusion of profits through circular transactions. The structures were so complex that even sophisticated analysts couldn't figure out what was really going on. The footnotes describing these entities ran for pages and were written in language that seemed designed to obscure rather than illuminate. When Enron collapsed in 2001, it was the largest bankruptcy in American history at that time. Investors lost tens of billions of dollars. Employees lost their retirement savings. And the accounting firm that had blessed all of this, Arthur Andersen, was destroyed. But here's the troubling thing. The basic techniques Enron used are still legal. Companies still use special purpose entities. They still structure transactions to keep debt off their balance sheets. The rules have been tightened since Enron, but the fundamental flexibility remains. How do you spot off balance sheet liabilities? This is more difficult than the other tricks, because the whole point is to make these obligations invisible. But there are techniques. First, read the footnotes on leases and other commitments. Companies are required to disclose future obligations, even if they're not on the balance sheet. Look for operating lease commitments, purchase obligations, and guarantees. Add these to the reported debt to get a truer picture of the company's total obligations. Second, read the footnotes on variable interest entities. Companies have to disclose their involvement with these structures. If you see a company with significant VIA exposure, try to understand what those entities do and what risks they might pose. Third, compare total debt on the balance sheet to the debt metrics used in loan covenants. Companies often have to report different debt figures to their banks than they report to investors. If you can find covenant compliance reports, they sometimes reveal hidden debt. Fourth, look at the cash flow statement for clues. If a company is making lease payments or other payments that aren't reflected in the balance sheet debt, you can sometimes see them in the operating or financing sections of the cash flow statement. Fifth, and this is important, compare the company's leverage ratios to its competitors. If one company in an industry appears to have much lower debt than everyone else, that might not mean it is better managed. It might mean it is better at hiding leverage. Let me give you a more recent example. In the years before the 2008 financial crisis, many banks used off-balance sheet vehicles to hold mortgage-related assets. These vehicles were technically separate from the banks. They had their own debt. They held billions of dollars of securities. The banks provided credit lines and other support to these vehicles, but because of how the rules were interpreted, they didn't have to consolidate them. So a bank's balance sheet might show leverage of 15-1, but the true economic leverage, including the off-balance sheet vehicles, might have been 30 or 40-1. When the housing market collapsed and those mortgage securities plunged in value, the banks had to bring the vehicles back onto their balance sheets. Suddenly, the hidden leverage became visible. And for some banks, like Citigroup, the results were catastrophic. The government had to step in with a massive bailout. Investors who had trusted the reported leverage ratios without understanding the off-balance sheet exposure were blindsided. They thought they were investing in moderately leveraged banks, but they were actually investing in highly leveraged speculation on housing prices. Now let me step back and synthesize what we've learned about these three accounting tricks. Revenue recognition manipulation, earnings smoothing through cookie jar reserves, and off. Balance sheet liabilities all share common characteristics. They're all technically legal, at least within certain bounds. They all exploit the flexibility that accounting rules necessarily provide. They all create a gap between reported numbers and economic reality, and they all tend to make companies look better than they actually are. But there is an even more important commonality. These tricks all share the same ultimate motivation, which is to boost the stock price in the short term, even if it damages the company and its investors in the long term. The executives who use these techniques often have huge amounts of stock options and restricted shares. Their personal wealth depends on the stock price. They have every incentive to make the numbers look good now, even if it creates problems later. By the time the truth comes out, they may have already sold their shares and moved on. This is why I always pay attention to management compensation. If executives are rewarded primarily through stock options with short vesting periods, they have an incentive to play accounting games. If they're rewarded primarily through long-term ownership of actual shares that they have to hold for years, they have an incentive to tell the truth. I also pay attention to what management does, not just what they say. If executives are selling shares while telling investors the company is doing great, that is a massive red flag. If they're buying shares with their own money, that is a positive signal. Actions reveal what people really believe. Another commonality is that these tricks tend to accelerate and intensify as companies get into trouble. A company that manipulates revenue a little bit in good times might manipulate it a lot in bad times. A company that smooths earnings modestly when business is strong might engage in massive reserve releases when business weakens. This creates a dangerous dynamic. The worse a company is actually doing, the more incentive management has to hide it. And the more they hide, the bigger the eventual reckoning. The gap between reported reality and actual reality grows wider until it finally snaps shut, often catastrophically. This is why accounting frauds often seem to come out of nowhere. The stock is doing great, the numbers look fine, and then suddenly everything collapses. But the reality is that the problems were building for years. They were just hidden by increasingly aggressive accounting. So how do you apply these lessons to your own investing? Let me give you a practical framework first. Never trust any single number. Cross-check everything. Compare earnings to cash flow. Compare revenue to receivables. Compare reported debt to total obligations. The truth usually reveals itself through inconsistency. Second, read the footnotes. I know this is tedious. I know most people skip over them. That is precisely why accounting manipulators hide important information there. The footnotes are where companies are required to disclose the details that don't fit the narrative they want to tell. Third, watch for changes. Accounting manipulations often require changes in policies or estimates. If a company changes its revenue recognition policy, changes its depreciation method, changes its reserve assumptions, ask yourself why. Sometimes there are legitimate reasons. Often there aren't. Fourth, compare to competitors. If one company in an industry has dramatically different accounting policies than everyone else, that is a warning sign. The best way to understand what is normal is to look at what other companies do. Fifth, follow the cash. This is my most important rule. Cash is extremely difficult to manipulate. A company can report phantom revenue, but it can't report phantom cash. A company can create cookie jar reserves, but it can't create cookie jar cash. When in doubt, focus on cash generation. Sixth, be skeptical of complexity. The most dangerous accounting manipulations are usually wrapped in complexity. Companies create Byzantine structures not because they need to, but because complexity hides the truth. If you can't understand how a company makes money after reading its financial statements, that is not your failing. That might be the company's intention. Seventh, consider management character. At the end of the day, accounting manipulation is a choice made by human beings. Companies with honest, straightforward management rarely engage in these tricks. Companies with aggressive, short-term focused management often do. I look for managers who admit mistakes, who talk plainly about challenges, who have significant long-term ownership in their companies, and who have track records of integrity. I avoid managers who always have excuses, who use jargon to obscure rather than explain, who are constantly selling shares, and who have histories of aggressive accounting. Now I want to close with something important. I am not telling you that every company is manipulating its accounting. Most companies, most of the time, report their numbers honestly. The accounting rules exist for good reasons, and most management teams use them appropriately. But some companies don't. And the damage from investing in those companies can be catastrophic. A single Enron or WorldCom in your portfolio can wipe out years of gains from your other investments. The goal isn't to become paranoid. The goal is to become discerning, to know what questions to ask, to understand where the bodies might be buried, to recognize the warning signs that most investors miss. I've been doing this for over 7 decades, and I still get surprised sometimes. I still occasionally miss manipulations that I should have caught. This is a difficult game. The companies that are gaming their numbers are highly motivated to avoid detection. They hire smart accountants and lawyers. They work within the rules just enough to stay legal. But over a long career, I've found that skepticism about accounting numbers is one of the most reliable ways to avoid catastrophic losses. Most of my biggest mistakes have come when I trusted numbers that I shouldn't have trusted, and most of my biggest successes have come when I saw through accounting illusions that fooled everyone else. The 3 tricks I've shared with you today, revenue recognition manipulation, earnings smoothing, and off-balance sheet liabilities, these are the techniques that have destroyed the most investor wealth over my lifetime. They're not the only accounting tricks out there, but they're the most important ones to understand. Learn to spot them, practice looking for the warning signs, build a habit of skepticism about reported numbers, and always compare what management says to what the cash flow statement reveals. If you do these things, You'll have an enormous advantage over most investors. You'll be able to see through the illusions that trap others. You'll be able to avoid the catastrophic losses that come from trusting numbers that were designed to deceive. That is not a guarantee of success. Nothing in investing is guaranteed, but it is a foundation. It is a set of tools that will serve you well for the rest of your investing life. The financial world is full of people who want to take your money through clever presentations and manipulated numbers. Your job is to see through the presentations to the truth underneath. These 3 accounting tricks are the most common ways that truth gets obscured. Now you know what to look for. The rest is up to you.